Decentralized finance, DeFi has revolutionized financial markets, but it also presents unique challenges. One such challenge is impermanent loss, a critical aspect of liquidity provision within DeFi. Providing liquidity to a decentralized exchange, DEX, involves depositing two crypto assets, such as ETH and USDC, into a pool. Impermanent loss arises when the price ratio of these two assets changes from the time of your initial deposit. Essentially, it represents the potential profit lost compared to simply holding those assets in your wallet. Navigating the DeFi landscape requires understanding the nuances of impermanent loss and its implications for liquidity providers. Impermanent loss occurs when the price ratio of the deposited tokens changes from the initial deposit point. For example, if ETH appreciates against USDC after you've deposited them into a liquidity pool, you'll incur impermanent loss. The extent of this loss is directly proportional to the magnitude of the price divergence between the two assets. However, providing liquidity can still be profitable. If the trading fees earned outweigh the impermanent loss, you remain in a net positive position. Understanding the mechanics of automated market makers, AMMs, which automatically adjust token prices within liquidity pools, is essential for mitigating this risk. Delving further into the mechanics of impermanent loss reveals how price fluctuations impact liquidity providers. Impermanent loss materializes when the price ratio of your deposited assets changes. The greater the price fluctuation, the larger the potential impermanent loss. This can result in a lower dollar value of your withdrawn assets compared to holding them. For instance, if ETH doubles in price after being deposited with USDC, the pool rebalances to maintain the 50-50 ratio, leaving you with less ETH and more USDC upon withdrawal than if you had held them. However, pools with stable price ratios, such as stablecoin pairs like USDC, USDT, minimize the risk of impermanent loss. The allure of decentralized finance, DeFi continues to attract liquidity providers, LPs, despite the inherent risks, particularly impermanent loss. This participation is driven by several factors, primary among them being the collection of trading fees. Platforms like Uniswap distribute a percentage of every trade to LPs. For example, providing liquidity to a USDC ETH pool on Uniswap v3 earns you a portion of each trade's fee, offsetting potential losses. Furthermore, high trading volume, especially for popular pairs like WBTC, ETH on platforms like SushiSwap, can generate substantial fees, exceeding impermanent loss and driving profitability. Finally, overall profitability hinges on a combination of factors, including the chosen protocol, specific pool, assets involved, and prevailing market conditions. Stablecoin pools on Curve, for instance, often offer higher returns due to the platform's stablecoin optimized design, reducing impermanent loss risk and leveraging a specialized fee structure. Impermanent loss, a key concept in DeFi, can be illustrated with a simple example. Imagine Alice deposits 1 ETH and 100 USDC into a liquidity pool when 1 ETH is worth 100, giving her a 200 total deposit and a 10% pool share. If ETH's price rises to 400, arbitrage traders will rebalance the pool by adding USDC and removing ETH until the pool's ratio reflects the new market price. The automated market maker, AMM, using its constant product formula, adjusts the pool to hold roughly 5 ETH and 2,000 USDC. Alice, withdrawing her 10% share, receives 0.5 ETH and 200 USDC A 400 value. Had she held her original assets, their value would be 500, 1 ETH at 400 plus 100 USDC. This 100 difference represents Alice's impermanent loss, termed impermanent because it vanishes if the ETH USDC price ratio reverts to its initial state. Understanding impermanent loss estimation is crucial for effective liquidity provision. This loss arises from shifts in a pool's asset price ratio, irrespective of price direction. The magnitude of the loss correlates with the deviation of the current price ratio from the initial deposit ratio. Small price ratio changes yield minor losses. For instance, a 1.25x change results in a 0.6% loss, while a 1.5x change leads to a 2% loss. However, this loss escalates non-linearly. A doubling in price, 2x, causes a 5.7% loss, and a 5x change results in a substantial 25.5% loss. This relationship is visualized in the chart, where the x-axis represents the current price relative to the initial price, and the y-axis tracks the change in total equity, clearly demonstrating the increasing impact of price ratio divergence. Protecting your investments. Strategies for mitigating liquidity provision risks. Providing liquidity to an automated market maker, AMM, offers attractive returns, but it also comes with inherent risks, most notably impermanent loss. One crucial strategy to offset potential losses is through trading fees earned within the liquidity pool. Accrued on each swap, these fees are distributed proportionally to liquidity providers based on their contribution. Understanding the fee structure of a specific pool is essential before participating. Starting with a smaller investment is another prudent approach. This allows you to familiarize yourself with the pool's dynamics, assess real-time risks and returns, and avoid overexposure before committing significant capital. Asset volatility plays a significant role in impermanent loss. Therefore, consider the price stability of the assets within a pool. Pairing a stable coin like USDC with a volatile asset like ETH generally carries a higher risk of impermanent loss compared to a stablecoin pair. Finally, protocol security is paramount. To minimize the risk of bugs or exploits compromising your funds, prioritize well-established audited AMMs over newer unaudited platforms. Minimizing impermanent loss. Advanced strategies in modern AMMs. Beyond basic risk management, modern AMMs offer advanced features designed to further mitigate impermanent loss. One such feature is the use of stable pairs, typically comprised of two stablecoins pegged to the same fiat currency. This minimizes the risk of impermanent loss due to the stability of the paired assets. Concentrated liquidity is another innovative approach. This feature allows liquidity providers LPs to focus their capital within specific price ranges, optimizing returns and reducing exposure to broader price fluctuations. Single-sided liquidity provision is a more recent development that permits users to deposit only one asset into a pool. This simplifies the process and further reduces impermanent loss risk while potentially offering additional benefits such as earning rewards. Actively monitoring prices enables LPs to anticipate potential volatility and make informed decisions about liquidity adjustments. Examples include Uniswap v3 for concentrated liquidity and Balancer for single-sided liquidity provision. By staying informed about market conditions, LPs can proactively manage their risk exposure. Understanding impermanent loss. A practical example. Let's illustrate impermanent loss with a real-world scenario. Alice deposits 1 ETH and 100 USDC, totaling 200 in value, into a liquidity pool when 1 ETH is worth 100. The price of ETH subsequently increases to 400. Due to arbitrage trading within the pool, Alice's holdings adjust to 0.5 ETH and 200 USDC upon withdrawal, maintaining a total value of 400. However, had Alice held her initial assets, they would now be worth 500. 1 ETH at 400 plus 100 USDC. The 100 difference represents the impermanent loss, 20% of her potential holdings. This example highlights that impermanent loss can occur even when the overall value of the liquidity position increases. The term impermanent indicates that the loss could be reversed if the ETH price returns to its initial level before Alice withdraws. However, once liquidity is removed, the loss becomes permanent. Navigating the complexities of impermanent loss is crucial for success in decentralized finance, DeFi. Impermanent loss is a temporary reduction in value experienced by liquidity providers and automated market makers, AMMs, when the price ratio of deposited assets changes. Let's demystify this concept and explore strategies to mitigate its impact. While impermanent loss presents a real risk, understanding how it works allows for informed decision-making. This can be achieved by carefully selecting pools, diligently monitoring price fluctuations, and factoring in the potential offsetting gains from trading fees. These strategies can enhance the profitability of your DeFi investments. For those seeking further information, I recommend researching resources on stablecoin depegging, AMMs, Uniswap, and DeFi in general. I trust this presentation has provided valuable insights into understanding and mitigating impermanent loss in DeFi.